There is actually an emotional cost to renting too long. You are totally and utterly at the whim of the landlord.
Do they not understand that they're throwing money to the wind? Because otherwise you are losing so much equity.
You're making 5% off the purchase price, not your money that you actually took out of the market.
Yes.
I don't ever want anybody to tell me I have to move out in 30 days.
Hey everyone! Welcome to our show. I am so excited today to have two of my absolute most favorite colleagues on with me. I have worked with Jolene Messmer and Rick King for years, and they have both been in the business for 20 plus years, as have I. And we're going to talk about so many incredible topics today that are going to be very helpful for first-time homebuyers, move-up buyers, if you're thinking of downsizing, realtor partners, any of the financial advisors we work with, CPAs. We're going to cover a whole host of things on everything real estate and finance. So get ready for a great show. And I'm just excited to talk with both of you guys because we collaborate so much. And I think that a lot of realtors and consumers don't realize how difficult it actually is to get into a home and to get a mortgage. And so I'm just so excited about everything that we are going to cover today.
Thanks,
Welcome
Grace, for
to the
having us.
show.
Thanks.
Yeah.
Appreciate it.
Yes.
Honored to be here.
I think one of the biggest things, I've always loved collaborating with both of you. I highly respect you both as people and as professionals, and I love your approaches. And, so many times I know that I've found over the years, like I've reached out to you and said, hey, Jojo, I've got this scenario. What do you think? Like maybe I'm just thinking about this one way and I could think about it a whole different way. And the same with you. And you both will come from a different perspective that I hadn't thought of that helped me solve a problem for a client. And I thought that, that's just something that's so relevant that I think consumers don't realize that when they pick their lender, that's an important aspect because not all lenders are created equal. They don't have the same experience, and not all lenders have that type of a collaborative environment. So I would love to just get your thoughts on that too. Like as we've all worked together, come up in the industry, like would love your thoughts on that.
Well, as we know, not all lenders are created equal.
This is true.
There is a lot of institutions out there that the loan officers don't even have to be educated.
Yeah.
They don't take the SAFE test. I'm sure they all do a background check, but unlike us, pretty much every 5 years, we're giving fingerprints, and they check our credit every three to 5 years, and it's pretty much like you're going to the doctor.
Well, we have FBI background checks,
Correct,
too, because we have to be upstanding citizens to do this.
That's
We're
right.
dealing with money. We're dealing with people's lives. There's a lot of people don't realize, like the big banks, banking institutions, you don't have to actually have a mortgage license to do loans. Us, because we're with independent lenders, we do have to have licenses, a federal as well as every state that we operate in.
And when you say that we deal in cash, we actually don't have cash on site.
Yes.
But we do deal with, warehouse lines. We deal, we see everybody's good and bad and ugly.
Yeah.
And, from credit reports to, social security numbers, banking accounts, investment accounts.
Yeah.
So
For sure.
it's all there.
Yeah. Yeah. What are your thoughts on like all the years of collaborating and kind of like how it's affected your business and helped your business?
I think the biggest thing is the confidence that I'm able to bring back to my consumer.
Yeah.
I sometimes get kind of emotionally tied to my consumer and what their scenario is and trying to fix a small problem, but there's probably a bigger problem that I'm not thinking about. And being able to call you on a whim at 7:00 in the morning, dropping off kids and just being like, let's run this deal. What am I missing? Or what can I do to find a better solution, a lower rate, a cheaper cost? And the collaboration of us putting our minds together to really deep dive into a client's loan application at a high level has just been creating more opportunities for consumers.
Yeah. I fully agree with that. I think it's a big benefit too to our referral partners. just last night, I had one of my longtime agents reach out to me. She is representing a buyer who had already had their lender established, and it's an online lender, and they're relocating. So relocating from California to Washington, and their job is down in California, and they're a week away from closing, and the lender is now saying, well, we can't close your loan because you can't get us the remote work letter. And so she reached out to me and she said, what do we do here? And I said, well, what's the scoop? Like, what's really the real story? Well, lo and behold, the plan is he's moved his family up here. He is going to stay working down there in California during the week, come up on weekends, and ultimately plans to move up here full time and quit his job.
Yeah.
And I said, well, I'm going to guess that the online lender didn't go through and ask all the questions to find out what the real goal was here. Just like we tell our clients, tell us the full story.
Yep.
Give us the full scoop, because that's where we can really help and devise that strategy that's going to be successful to ultimately get you to the finish line when you need to be there, but successfully. And so sure enough, no, that lender had not dug deeper, had not asked those questions, and now they're stuck because there's so many different ways you could go with that. Like,
I know.
If
I want to solve this problem right
yes,
now.
Yes.
Well, so
we could go assets. I said, well, we would just go with assets. We wouldn't even bring the employment situation into the mix.
Well,
because
and my first question would be, if he's working down there, technically he's not working remotely. He could travel up here every weekend.
Yeah.
He's moving his family. That is now the family's primary residence.
Yes.
And technically he wouldn't need a remote work letter. That would be my thought.
That would be another angle.
Mm-hmm.
That would be another
So
angle.
I think they turned a stone that they couldn't turn back over because they didn't ask the questions up front.
Yes.
For that to come up a week before closing,
Yep.
that loan officer, it's their fault at the end of the day.
Yeah. That's inexperience.
Right.
Yes.
I mean, you can also, where is he staying down there?
Yes.
Right? Like,
Hit them with the rent payment, and then you're
Yes.
you're
Yes.
fine.
easy solve.
Yes.
Yeah, absolutely. Yeah, there's a million ways you could go.
ways. Yeah.
But
Right.
that's where experience,
Yeah.
collaboration, and that's the piece that a lot of times consumers, they don't realize that these are the types of questions we ask up front to ensure we're thorough, that we make sure that when the loan goes into underwriting, because you're right, now it's in underwriting, now there's problems, the underwriter's suspicious, and the underwriter's going to start looking, is picking that thing apart because it didn't go in correct.
Well, and I'm willing to bet that that loan officer probably was not able to pick up the phone and call the underwriter. Like us, we know all of our underwriters because we worked with a lot of them for 2 decades.
Yes.
And again, it depends on the lender. It's, if you don't have a great team, you're shooting yourself in the foot right out of the gate.
Yeah. Oh, I agree. Well, and one of the things that we, the last 5 years has been a different market. And we hear from different people in the industry or consumers, oh, no, this market's bad. I mean, it's bad. No, it's not bad. It's just different.
Right.
And
It's
this
normal.
is how markets are.
Right.
And I'd be curious to get your guys' thoughts on, like, over the last 5 years, we've really had to change a lot of how we navigate and how we work with buyers. There's a lot of fear that's in the market with these buyers, and some buyers sitting on the sidelines. What are some of the ways that you guys have approached buyers and educate them to, like, bring that confidence back, kind of explain that market and navigate with
Go,
them?
Jolene.
This is my favorite topics.
I love it.
I like to remind these buyers the barrier to entry.
Yes.
Okay. The barrier to entry is pretty much 3 things, right? You have to be 18 years old. Mm-hmm. You need a credit score of about 620, and you need income.
Yes.
You don't need a down payment.
Yeah.
And so telling people the barrier to entry kind of gets them relaxed and says, oh, I have all 3 things. I can buy a home. My answer is yes, you can. Now let's talk about how we're going to get you qualified and what product will work best for you. And so trying to get people to understand the process of mortgage and the fact that we have 138 different loan options is mind-blowing to people.
Yeah.
So we have so many 0 down, low down, right? Different ways to qualify with income, you may not even have income and we can qualify you, all those things. And so just breaking them down and just taking the time to educate them on what options are on the table before saying, fill out my loan app. Right? That's not the first words we use. We say, let's talk about it. Tell me more. Let's put the mortgage strategy together. And then we're going to back it up with your loan application, your documents, and then be able to issue that letter to you.
And what I have found is those people that now are struggling to qualify because their income rates are significantly higher.
Yeah.
So they don't qualify for the millions. Now they only qualify for maybe 750. They were sitting on the sidelines when they could have qualified for that million. It's almost, do they truly want to buy? Do they not understand that they're throwing money to the wind? So many people don't understand that your appreciation is based off of your $750,000, not your $10,000 in earnest money or down payment making 2%.
Yes.
There's a huge difference there. And they're truly throwing money out the window when they don't sit down, figure it out. Okay, you don't qualify for the million now. Buy the 750, get in the market, because otherwise you are losing so much equity in the next 3 years before you can qualify for that $1 million home.
Yeah.
Don't
exactly.
wait. Now there's no bad time to buy.
There isn't. And the market is what the market is.
Right.
And the bottom line is when you rent, you're just making your rent payment pays the landlord's mortgage. You're
100%
buying a house to the
interest.
landlord.
100%
What I
interest.
loved was the story you told me about the family member of yours. I think it was your nephew.
Yeah.
Yes.
I would love for you to share that story because you completely will change his life.
Yes. So this is a great story. My nephew wanted to buy a house and he started shopping around and then rates started going up and he got scared. So he pulled out of the market. The following year, he's now living with his girlfriend in a brand new apartment. Okay. Brand new swimming pool, a big, beautiful barbecuer. It's got a brand new workout room and it's got 2 dog bathing areas. Okay. And guess how many dogs he has? 2.
2.
Could you imagine having 2 bathing areas for your dog at the same time?
Right.
Oh, magic, right? He's like, I'm never going to leave this place.
Like candy.
Yeah. Then his girlfriend was out playing with the dogs, and one of her dogs bit her. Okay, not very hard. It wasn't tragic. Anyways, somebody who worked for that apartment complex saw it and turned it in, and guess what? They got a notice that they need to get rid of their dogs, or they've got 30 days to vacate that property.
And let me guess, they were probably paying $25,000 to $3,000.
Yeah.
Oh yeah.
Yeah.
So of course they're not getting rid of their dog.
Right.
So they took the dog and put it into training school. So the dog's doing great today. And they decided, I don't ever want anybody to tell me I have to move out in 30 days or get rid of my dog.
Yep.
Okay.
Lack of control.
Lack
You're
of
renting.
control.
Yeah.
So guess what? He is now a homeowner and he's very happy. And they have this huge fenced backyard for their dog.
Yeah. And that's the thing. You showed them the possibility by getting them in at their age. They will be so far ahead of each other, ahead of other people that continued renting.
Yeah.
Because it isn't timing the market, it's time in the market.
Thank you.
So like you just said, if had those people bought 3 years prior, you know, every year you don't get in, you're falling behind.
Right.
Whereas you're better off to just get in, smaller house, less expensive house. Maybe you have to live a little bit further out, but you're getting in and you're getting on the equity train. And that's the piece that a lot of people just don't, that they don't quite understand that concept.
Well, and so let's use quick numbers, say 700,000 and a round number of 10% appreciation. That's 7,000 a year. In that 3 years, they lost $21,000 that they could have used towards a down payment. That they aren't going to get. They're not going to make it back because they can't turn back the clock.
Yeah. Well, and I think fear is what it's the emotional cost, right? We talk about like there is actually an emotional cost to renting too long. There really is. Buying a home is not only financial, there's a huge emotional element that actually plays into that whole cost, the emotional cost of renting too long. Because when you're renting too long, you're not building your own equity. You are totally and utterly at the whim of the landlord. And this, just like what you just shared about, your dog acts out and there's some rule in there that another renter, there's a rule in the guidelines and another renter turns them in. And so now you have to move. You have no control over your rents going up. You have no control over your payment. You're not building any equity. You're just making the landlord richer. And, you're not getting ahead. And that's the emotional cost of it versus, being able to jump into your own home, and yeah, there's fear. Oh my gosh, what happens in the market? But what I would love is how you guys have talked through that fear that a lot of these home buyers have, especially with all the changes that have happened in the last 5 years.
Yeah. I actually just had a client today that I met with, and he's renting and he has to be out in 6 weeks or he has to re-sign another year. Yeah. So he's weighing it out. And guess who his advisor is? AI.
Oh, yes.
AI is his advisor.
AI.
So he told me that AI said he qualifies for a $5,200 mortgage payment. I said, great, let's do a pre-qual. I found out his income, his debts, and guess what? He qualifies for an $8,500 mortgage payment. Okay?
Yeah.
So there's AI fake news, number one.
Yes.
Number two, what AI and what people are not thinking about is when you take money out of the market, right, where you're making maybe 15% return on, let's call it $32,000, because that's what's his down payment. You're going to make 15% off 32,000. Then you buy a home that is, I don't know what I think his price was, $695. In 5 years at a 5% appreciation, his equity growth that he got from his down payment appreciation, the earnest money, as you say, was 685%, because that's how much he made off his $32,000.
Yeah, the
right?
ROI.
Because you're making 5% off the purchase price, just like you said, right? That not your money that you actually took out of the market.
Yes.
So when people start looking at return on their investment, I show them a 5-year look ahead so they can see why to buy. You're not buying because you think your $32,000 is going to earn you more money, right? Perhaps it's because you want the appreciation. And that's what people have to remember.
Well, in the simple fact, just looking at their budget and saying, okay, 3,000 seems like a lot, but you're paying $2,500 now.
Yeah.
You've got tax benefits that you're not even realizing. And okay, you know what? You go to Starbucks 3 times a day because I can see it here on your debit card. That's right now, $21 a day that you're just throwing to the wind. Stop. Cut back on your expenses. So you go to the bar instead of every night, 3 nights a week.
Yeah.
There's ways to make up that $500. And the fact that, again, you're making the appreciation. You're not paying the landlord's rent, like Jolene had mentioned.
Right.
It's 100% interest that you're paying.
Yeah.
And it's not, you don't get to write that off in your taxes.
It's 100, but you don't get to write off. That's the other thing a lot of people don't realize or think through the tax write-offs.
Right.
That you can actually afford a larger mortgage payment and it equates to a lower rent payment because of the tax and the tax write-offs. And you get to write off not only the interest, plus you get to write off the property taxes. I think a big barrier is people still, I can't even believe in 2026, they still think you got to have 20% down.
They do.
Which it's crazy.
You're 100% correct.
Yeah. And they don't. I mean, I can't even, most of the loans we do are much less than 20% down.
Right.
Well, and they're probably getting advice from their family who have maybe purchased 30, 40, 50 years ago, and they probably don't even have a mortgage.
Yes.
I've had the situation where the client's parents came out to do a walkthrough with them, and it was a $2.4 million. And the parents like, you can't afford it. No. So they backed out. A year later, they bought 2.5.
Yeah.
And it's like, okay, that's a lot of appreciation you've lost in this past year. And now you're paying more for a home that had you bought it last year, it would have been cheaper. And so it's not, probably the parents are not, or family members, not the best person to get advice from. Most financial advisors would advise you different. I think the parents are looking out for the kids because, yes, that's, $11,000, $12,000, $13,000 a month payment. And that's probably a third of their income back when they were working.
Yes.
So they don't understand everything today is relative.
Well, the old money rules that applied 30 years ago don't apply today. I mean,
Correct.
houses were a lot less relative to income.
Correct.
There was also less investment opportunities that there are now today. Investing in markets was a lot less accessible back
Right.
then. And there was more limited loans that were available. Back when our parents bought their first houses, you had to put 20% down because there wasn't a secondary market
Right.
like what we deal in today. So the bank actually physically had to have the cash in their account to make that loan. So, they were limited to the type of loans versus, now we're making loans based on lines of credit that, get sold back off and that money becomes available. It's like there's not an end to it. There's plenty of money out there. But yeah, it's interesting the myths that still exist that hold people back that I think are really interesting.
And even just different parts of the U.S., people don't understand the price of homes out here are not what they are in the Midwest. I mean, I remember my parents' mortgage was $30,000. Monthly payment was $150.
Yeah.
That was huge back then.
Yes.
I mean,
Yeah.
I remember gas
Yeah.
being 25 cents. So that tells you the difference between, 50 years ago and now. And, people in the Midwest can't understand that. Oh my God, your home's worth $1 million, your home's worth $2 million. Because yours is only worth like maybe 150, 200. So they just can't fathom, and they probably have a bigger house and land.
Well, and that's what's interesting is there's a lot of people that are getting ready to retire that have these really big homes
Right.
that they're sitting on, lots of equity. And we need those homes freed up actually so that new buyers can buy them. And some of these people are leery of selling them because of the next move, the downsizing or the right sizing and how they're going to do that, and looking at, that how much prices have gone up.
Tax consequences.
Yeah, I would love to hear from you guys on some of your clients that are doing the downsizing or right sizing as they're entering like a new phase of life. Maybe they're thinking ahead 10 years to retirement, their kids are leaving, their kids are going to college. How have you worked with clients and advised them on that when they're like, God, I'm sitting on this huge house, but it's got so much equity, my payment's really low, or it's own free and clear? What do you tell them?
I think there's two ways to look at it.
Yeah.
Depending who that homeowner is. My last conversation I had yesterday was with somebody who really wants to stay in their house, but they want to retire in 3 years, but they can't afford this payment in 3 years. So I shared our reverse mortgage contact with them. And I think reverse mortgages are absolutely amazing.
Yes.
And that is a whole nother podcast you could talk about on that, because there's so many myths with it. And the biggest myth is if you don't ask the questions, if you don't understand the product, you can't have an opinion yet.
Yes.
Until you learn about it. Because it is a magical program that allows people to use the equity they created, that they built, so they don't get to have a payment in the future.
Yes. Right. Yes.
So there's that buyer, and then there's the I want to buy before I sell buyer.
Yes.
And that's probably all of our number one buyer in this market right now.
It's the hot product.
It's the hottest one is how do I buy first and then sell my home because of home improvements? This one just came available. How do I do it?
Yeah.
And I think that's where the three of us shine the brightest
Right.
over any other product. Mortgage strategy is this one right here.
Yes.
Rick, tell us about it.
I've actually had it is probably the hottest product right now. It is.
Yeah.
People just don't get. You get probably, if they've been in their house for a number of years, they've got at least 30, 40, 50% equity. The way the product works is if you've got 20% equity in the home, we will actually remove that payment from the debt to income ratio, allowing them to qualify for the new purchase. But it goes further than that. They might not want to pull their money out of the market for the down payment.
Yes.
Let's do a HELOC.
Yep.
Let's pull equity out. It's still their primary. They're not in contract, so we can treat it as their primary. And then that way, as long as we don't go over 80% loan to value, we still don't have to hit them with that first mortgage or the HELOC payment.
Yeah.
So now they're truly just purchasing the new home off of their income. It is a great product.
It's
It's,
better
it's
than
selling
a
like
bridge.
hotcakes.
Yep, better than a bridge. Why
Better
is
than a
that,
bridge.
Crease? Tell us why.
Because it's got a lot less. It costs literally a fifth the cost of a
Right.
typical bridge.
Mm-hmm.
And it can all be done it can all be done in a very, very quick time frame.
3 weeks.
Yes, it can all be
3
done.
weeks.
Yes.
Yeah.
And it gives them more control. It gives their agent more control on when they find that
Yeah.
house that they want to buy.
Because you don't have to feel
Phenomenal.
contingent upon the bridge closing. and-
Exactly.
Right.
Yeah. It's phenomenal. And to go back to what you're saying on the reverse, I could not agree with you more. Like phenomenal. And it's gotten a bad rap over the last 20 years. And the thing that people don't realize is the rules and guidelines have changed on
Well, and
the
it's governed
reverse
by,
loans.
It's governed by HUD now, whereas when it first came
Yes.
out 20 years ago, it wasn't. So it was
Yeah.
the wild, wild west. And
Yeah.
now it's tight now.
I'm going to do a podcast with Michael.
I was going to say,
Coming
Michael
up,
Joy, you're going
which
to get
is
a phone
going to
call.
be an incredible podcast to really educate.
Yeah.
Because even myself, until I went through and sat down and went through the training and also had a side conversation with Michael,
Yeah.
I didn't know some things. I had some assumptions. But if you're over the age of 62, that is absolutely a loan that you should be considering highly.
Yeah.
I mean, it will help a lot
100%.
of people.
Yeah.
You know, it's phenomenal. Yes. But I agree to go back to our better than a bridge. That's probably the most common that we're getting.
Yeah.
Right.
And I think going forward, it's going to continue to be a very, very relevant. I don't see that changing anytime soon. I mean, people want to get settled into the new house first, and it makes it also better for the agents and for them to be able to prep the house that they're currently in when they want to get it ready for sale, so
Correct.
that it shows the best, can sell at the highest amount.
Well, and overall, it's saving them a lot of cash because they're not having to pull money out of the market. So
Yeah.
they're not losing that portion of the money, and they're not having to pay Uncle Sam
Yes.
for potential capital gains that they on the profit that
Yes.
they made off of it. So it is definitely a much cheaper product, and
Yeah.
like Jolene mentioned, it's a cakewalk. It really is.
It's totally a cakewalk. Yeah. It's a great tool. It's interesting. I always feel like every year has a theme. And you have to kind of get into the year before you start to like, okay, I'm getting a feel for what 2026 the theme is going to be. Have you guys, like now that we're closing in on actually the last business day of January, what are you guys feeling as the theme for this year?
Well, I can definitely say, just so people are totally understanding, this isn't 06, 07, where if you could breathe and it
Yes.
showed up on a mirror that you were getting credit.
Yeah.
Today, people are truly qualifying.
Yeah.
Guidelines are definitely stricter, so they're protecting the consumer. And that's our job to make sure that we're educating every borrower. 2026 is going to be interesting.
Yes.
I really think we're going to see a lot more homes open up. I think people are finally to a point where they know that they have to upgrade or downsize. And the longer they wait, that house that they want is costing them more. So
What do you think?
Ooh, so when I think about a theme for this year and like the first 30 days we've already been through, it's been a wild ride this last
Yes.
30 days.
Yes.
I feel like we're on fire, and I think everything is going to be better this year, right? We've got Fannie and Freddie who don't really want to participate in the investment and second home loans, right? And so now we've got these non-QM investors stepping up to the plate saying, we don't need these LLPAs on this product. We're going to give them fair market rates. We're not going to do these add-ons to the rates like the conventional loan products. So I feel like other people are believing in giving money out. They're believing in the mortgage has a good return on investment as an investor. And we're having more products enter the market. We have a new one on Monday, right? We now have 45 different investors.
Yeah. Yeah, the private market is finally jumping in.
Yes.
It's like they've been waiting on the sidelines, kind of
They
watching,
have.
and they're jumping in now because they've seen where the opportunities are. And they're absolutely exactly what you just said. They're in that second home and investment market, especially where they can go in and they'll just beat up Fannie Mae and Freddie Mac, which is great. Fannie Mae and Freddie Mac doesn't really want.
They don't want those loans
don't want
anyways,
those
so
loans
they'll take
anyway.
them.
So it's perfect. I would agree wholeheartedly on that. I think what I've seen as we go into this year, I feel like in my conversations with people finally have realized they're not just waiting for rates to drop. They
Yeah.
kind of realize like this is our new normal.
Right.
Yeah.
And rates are going to kind of stay. They're really expected to pretty much hover in this area. I mean, maybe between now and the end of the year, they're going to get 0.25% better. That's not a reason to put your life on hold.
What Matthew say at our event, it's going to seesaw between like 5.75 and 6.25
Yeah.
on a
Yeah.
30-year fix. So it's
Yeah.
like realistically, that's not a big difference.
Mm-hmm.
It's definitely not a big enough difference to wait it out.
Yes. I've seen it feels like people are moving on with their life and they're realizing not to put their life on hold for interest rates. And that I'm like, I really am, that's encouraging to see that we're finally kind of going there. And to your point, I think there's a lot of people sitting on homes that have a lot of equity that they've been waiting to make life decisions on. Maybe they do want to downsize and buy like a home closer to where their kids are, or they want to buy a vacation home somewhere where it's warm.
Yeah.
Right.
And that's the great thing is they can be helped in all of those, all those kind of areas. Yeah, it's going to be interesting. It's going to be exciting to see
Well, and
what those things.
the other big thing about buy before you sell is some of the bridge loans, they have a time frame that you have to pay them off. So it could be 90
Yeah.
days, it could be 120. Whereas
Yeah.
buy before you sell, okay, if it, you're making both payments, you've got the cash. You want to really do that extra, hardwood floors. You want to make that house as beautiful as possible for that next person to come along and recover as much of your investment as you can.
Yeah.
So that, the buy before you sell, it is definitely an incredible product.
Mm-hmm. Well, for sure. I think that too, the thing that we all do is really look at the whole picture with the customer, look at their whole financial strategy. That's really important. Like, I'm a big believer in people need to keep their money moving. Your money has to work harder for you than you did for it. And these big down payments, it's honestly like there are scenarios where that can make sense, especially look, if somebody's got their financial advisor involved, they're looking towards retirement, maybe that's part of the strategy, that can make sense. But a young person that comes in to buy a house and they're going to put 50% down, it just kills me. And it's a great opportunity to educate. And that's where the conversation starts, because a lot of times people don't realize, they're so focused in on that payment. They don't realize, gosh, okay, I could put 10% or 20. Take that other 30% that I would have put into that house.
Yeah.
Go invest it in a smart investment, whether it's whether it's that high yield savings or the S&P 500, or with their financial advisor who has another plan for them where it's going to give them a much higher rate of return than parking that money into the house. Because once it's parked, it's parked.
Yep.
It stops moving. It's dead equity. It's not working for them at all.
And you're only putting the investor in a better position.
Yes.
I think I actually spoke to you about a client. I think they were going to be at like 85% LTV based off of my calculations. And she was telling them to pull money out of their investments. And I'm like, okay, even with mortgage insurance, your rate was going to be like 6.25.
Yeah.
She was getting them 12 to 15 on their money. Why are you losing 6% on the money that's going to just set at the investor level inside the home, making you zero?
Yes.
I was so shocked. I almost advised them they should start looking for another financial advisor, because it's like, this is not rocket science. This is easy math, simple math.
Yes. Well, it's interesting. I mean, I have my review every year with my financial advisor. And one of the questions that, always comes up, she'll say, what's the balance on your mortgages? And she looks at it and she says, good. Do not pay extra towards principal, which I don't, because why would you do that when you're sitting on a, sub 3% interest rates?
Correct.
But even at 6, why would you put extra money into the house when you can take that money instead? Very conservatively, the S&P in the last 10 years after inflation has netted 10%. So you're
Yeah.
already 4% ahead.
Right.
And that's the strategy. I mean, that's the strategy that I always share anyway.
And they don't understand that they have to pay to get that money back out.
Yes, they have to do a loan.
Leave it in the market and let your
Yeah.
money make you money. How do they think
Yes.
the rich got rich? Using other people's
Exactly.
money.
Yes. Smart leverage
Right.
is how the real wealth is made, through real estate. And, like this particular customer, I said, okay, instead of taking them 50%, put 20% down. Now you have that other 30%. You can invest. Go buy yourself a rental property.
Right.
Go buy another house in a couple of years. Use this one as your starter home. Couple years. Next, you're going to go buy your move-up house. Not only are you going to make the equity, you're going to make the money off of these funds being invested.
Mm-hmm.
And it's truly working for you versus just being sunk into the equity. I mean, sure, you can brag. Yeah, I have 50% equity, but that's not paying you any extra return on investment every month, the bragging rights. So it's interesting. Yeah. It's one of the things that's fun. It makes this industry fun. When you guys look ahead to, that like market that we're in, what do you see? Like, what do you see as far as, things going back to the way they used to prior to 2020? What do you think?
No.
No.
I had this conversation today with
Yeah.
somebody. A client was like, okay, so what do you think spring market's going to look like? I'm like, it's busy.
Yeah.
Applications are up. It's busy. But you know what I'm not seeing is people being wild and crazy and going out and putting
Yeah.
ridiculous offers on the table, right? I will close in 2 weeks and you can
Yeah.
have a 200,000 earnest money released the day you accept my offer, and I'll go 300,000 above list price. I don't think we're going to see that. I think people are like, I want to buy a house. Rates are finally stable.
Yeah.
And I'm going to be smart about this. And there's inventory always coming to the market. So I feel like it's going to be a really peaceful and stable market for this year. And I think people are going to be more wise and thoughtful about buying. And I don't think there's not going to be this huge frenzy.
Well, and
I agree. Yeah.
And then it was all pretty much the, COVID pandemic that people just sat at home and all they could think about is, oh my God, let's get online and let's find that house.
Yeah.
And then their egos got involved and now they wanted to do that 300,000 over asking. The house was probably priced where it should have been to begin with.
Yes.
Now they're feeling the pain because prices they're not dropping, they're correcting.
Yes.
It's everything out in the Pacific Northwest, the West Coast. It's just going to correct. It's we're not truly losing because it was overinflated during the pandemic and, it couldn't sustain itself.
Well, it's balancing out.
Right.
It's balancing out. I think what's going to be interesting is with AI, to your point, lots of people go to AI. There's a lot of misinformation out on AI.
Garbage
And-
in, garbage out.
Exactly. And it's going to take time for the right information to get into AI. What do you think what do you guys each see the role of AI in buyers, how they go about making home buying decisions, lending decisions, real estate broker decisions? Like, how do you guys see it changing the face of our industry?
Oh,
Buyer beware is what I have to say. Don't make your decisions off of artificial intelligence. That's what you've got the agents for. That's what you've got us for. Yeah. We are the sounding board. We know exactly what's going on. And AI is only as good as the information that is out there on the web. And it's not going to be up to date unless there's something on the web posted about it.
I think what most people don't know is that our world changes every single day.
Yeah.
every
Right?
second.
Every second. I mean,
Yeah.
we've got a new program coming out on Monday, right? A guideline. We had 2 guideline changes today.
Right.
Interest rates. Did you guys know interest rates change multiple times a day?
Yeah.
How does AI supposed to know what today's rate really is?
You're right.
There's 26 different factors that go into an interest rate. Everyone's rate is completely different. There's we have 138 products. We've got 44 different investors. AI doesn't know all that. They don't have the guidelines. They don't have our scoring model,
Yeah.
right? So, I mean, AI is good for a brief understanding, but if you need a deep dive and you really want to figure out what your options truly are,
Yeah.
you have to go to an expert.
I totally agree with that perspective. I know that my opinion probably is different than a lot of people's will be on AI. I
Yeah.
fully agree with what you're saying. I think in certain industries like ours, it actually makes us more valuable. People are going to need us and their agent
Yeah.
even more. And the reason for that is because of all the things you just mentioned. Because there's so many factors
Right.
that AI they're not going to be up on every single little change and to be able to take into all of those factors right off the bat. It would take time. You can't mass customize that quickly.
We use rates, for instance. AI is not going to be able to say, okay, this investor's at 6, this investor's at 5.
Yeah.
They're not going to pick up that, oh, you might be paying 30 grand to get to 5%.
Yeah.
It's just going to spit out that, 5% because that's what it's finding.
Yeah.
The client isn't going to know that they're wasting $30,000 for that rate.
Well, and they don't know the specifics of the file.
Right.
To go, they'll qualify under that investor, but they're not going to qualify under this loan program with that investor. And those are all factors. That's why some loans fall out. Like the example I gave with my agent that called me last night. That's why it's falling out at that online investor. But the three of us would know how to completely repackage that loan today and get that through in no time.
No, we would have never got to this point.
We would have never gotten to this point. Yes, correct. Yeah. I think it's going to be interesting with like AI will play a role in job layoffs with certain industries, I think. Like if you're in the tech industry, for sure that's going to play a role, and that's going to potentially lead to some more layoffs. Some of those people will have to move. They're going to have to sell their properties. I do believe that will, and those people will have to decide what their next step is going to be on their careers.
Well, I could see AI coming into the lending world a little bit, but it's going to be on the true, your salary, your
Yeah.
score is this, where you can put in W-2s, pay stubs, as long as it's salary, and it's going to spit out exactly what we would get.
Yeah.
But the moment you get into somebody that's hourly, it's not going to be able to calculate the variable income. There's too many factors that it's just not going to. And I think at that point, it's just going to basically spit the file out and then have to be underwritten by a true underwriter to begin with.
Right. Yeah. Straightforward, it probably can be.
Right.
But if a person really wants to be DIY, I mean, there's a small segment of the population that wants to be DIY that they probably aren't meant to work with us anyway. And that's okay.
That's okay.
But the majority of people really want their handheld. And they need their handheld, and they need a custom solution for their scenario. I think what's interesting is with our agents, our referral partners, they ask great questions, and they're going through the same changes with the market as we are. I would love your perspectives on when you're talking with them and hearing from them, like, what do you think are some of the questions that they should be asking that they're not? To clients and stuff.
So I struggle with this all the time because I know it's difficult for agents. I'm not even going to question that. I mean, we've all been through it. It's the industry. Escrow's been through it. Title's been through it. The biggest thing that I think where agents truly start to fail is, why are you even showing that second home before you find out? Were you pre-approved? Can I get a pre-approval letter? Who's your lender? There's so many things that they should be asking up front. Don't spend your dollar because you don't know if you're going to make that dollar back. And online lenders, we know here in the Seattle market that a lot of agents, listing agents for sure, don't even want to look at the offer because they know that probably there's a good chance that they're not going to close on time. And why is that fair to the seller? Why is it fair to the agent to be delayed 2 weeks? And so many people, I think they look at it like, oh, it's only 2 weeks. No, it's not. You're affecting seller, the buyer, the agent, title, escrow. What if it's a domino effect? What if the seller is supposed to be buying another house? Now you're delaying them. They're buying another house. You're delaying them. So it could be, 5 and 6 homes deep that you've just delayed them
They
a
have
month.
moving trucks set up. They have
Right.
appliances coming in. Kids have to start school, or there's a trips that are planned. Yes.
And the stress level that the simple questions up front could truly handle a lot of that. And again, it depends on who you work with.
100%.
Because I know for myself, I'm very honest with the agents up front. This is going to be a struggle. I need more time to make sure. I want this to be credit approved before you make an offer.
Yeah.
So that, then you can make a 12-day closing offer. But if there's any question at all, get it out there so that it's not going to be the 11th hour Hail Mary,
Yeah.
because those don't always work, as we know, because we do a lot of rescued loans.
Yeah. Don't shop before you're pre-approved.
Right.
Yeah.
And I have so many clients, they don't know what they don't know. And of course, they're just going by what they've been told. Okay, they might make $300,000-400,000 a year, but then they might have 4 or 5 cars at $2,000-3,000 a month payment. Some of these people have a lot of toys. They might have high student loans. They don't understand that every piece of that goes into the puzzle. And until that puzzle is complete, they could be, wasting their time. And the moment that they lose out or potentially lose their earnest money, then they become discouraged and don't want to move forward in the future. And you never want that. I mean, that could totally ruin somebody's life.
Yeah. It just makes it more stressful. Yeah.
We can sum it up and say preparation is the separation.
Yeah.
And that is the key part that agents must instill into their clients to make sure that they have a positive experience. They get the house they want. So.
Right. And give us at least a day. Don't call, say we're making an offer tonight.
Yeah.
And you want us to crunch numbers, and then hopefully it's a salary where we can say, okay, this is golden. But that's usually not the case. A couple days, they haven't bought a house in 3 years. 2 days is not going to affect them. And if that house goes pending, that wasn't their house.
Yeah.
Everything happens for a reason.
I would agree with that. Doing a little work up front makes it's so much smoother for everybody on the back end. That would be my advice to these agents, is I know they're excited. They want to get out. They want to start looking at places, but it can be heartache if you're showing them, a $2 million house and their budget is only 1.3.
Oh, yeah.
It's hard to go back to them and be like, well, okay, now here's the 1.3 house. It's a lot different than the $2 million house.
And
Such a disappointment.
Yes.
And we truly are, the client's always going to be our number one.
100%.
But then the agent's number 2, because we want to get them paid.
Yes.
I mean,
we want to protect them. We want to protect their time more than anything. That's the last thing I hate to see is, the agent goes and takes this client out and shows them places, and then the client isn't prepared. We don't have the pre-approval done because the client didn't do that first. And then we find out, oh gosh, they either they qualify for a lot less, or now they don't qualify. There's a problem. And now the time is wasted from the agent.
And what if they even, go this next step further and write the offer, and then they have to, pull back the offer? It's now their reputation on the line, because it's a small industry.
Yeah.
Word travels fast. So if you get somebody out there writing offers and then pulling them back while they're being reviewed, the next time around, I had a client they did 3 in an area. The agent finally told them, if you do this again, this community is not going to allow you into the community because all the agents know each other.
Yeah.
And they're going to know that you're not serious.
Bad rap.
Mm-hmm.
Yeah. Yeah.
And the agent might get a black mark too, because they're the ones writing the offer and not understanding that the client probably just doesn't want to be in that area.
Yeah, one of the things is, I think with consumers, when they think about becoming a homeowner, it's big. It's a big step for them to make, and they a lot of times don't know where to start, and they just automatically think to go to their bank.
Yeah.
Or they think to look online.
Yeah.
And that's kind of just their first instinct. And they don't know any different.
Right.
And so when they walk into their bank, they're talking to this banker and it seems like it's the right thing to do. We know it's not. It's very different working with us who are dedicated mortgage lenders. This is all we do. We don't do credit cards, car loans, checking savings with a little mortgage department. This is all we do. We're mortgage experts. I would love your guys' thoughts from your perspective to share with our viewers about how you view our role in the market versus the online and the banking institutions.
Well, first off, we all work 9 days a week, 36 hours a day, right? Because our consumer goes to work 9 to 5 and they look at homes on the evenings and weekends. So when are we available? Evenings and weekends, and gladly available. So I think that's a huge separator to a lot of people, because you have to make these quick decisions. I also look at us as we're an advocate. We don't advocate for Movement Mortgage. We advocate for our consumer.
Yes.
Right?
Yeah.
And before we submit anything into underwriting, we scrub it. We don't just loosely put things in. We make sure it's the right document because we advocate for our client. So I think the biggest thing for people to know is we're really accessible because time is money and you need us when you need us, and that we're here to protect them. We work for them, right? They are the ones, they are the CEO, and we are here to make sure we deliver the product that they're coming for our advice for.
Yeah.
Well, and by going to a lot of those institutions, you're going to talk to one person maybe for your application. Then you're going to talk to somebody else for your documents. You are not reaching out to the same person. You are basically just hand along, like on that conveyor belt. I had one that they decided, because they could deposit money in the institution, that they were going to get a slightly better rate. Let me tell you, it was painful for them. They, until closing, they were calling me every 2 days. What do you think of this? What do you think of that? And of course, I'm not going to tell them to go pound sand, because that's not me. I want to help them no matter where they go, because I want to make sure what they're getting is truly what they should be getting. But I don't think a lot of clients realize that. I think that they don't realize the biggest thing that can almost bring me to tears is when a parent refers me their son. Now, that son or daughter refers me their kids. So, it could be 3 generations of people that we're dealing with for one family.
Yes.
And that's, I know each of us have dealt with multiple members in families. And it's incredible, because that is probably the most rewarding.
Yeah.
The clients for life. And we truly want these clients for life.
Right.
We're not here because the market's going to be great and then get out of the market and go do whatever. This is our life. And like Jolene had mentioned, we work 36 hours a day, 9 days a week. Yes, that does math. Do the math, people. It really does work. Yeah. We all have taken those late night phone calls. But what we also want the consumer to understand, that we are giving of ourselves. I don't think they realize that 7 o'clock call, now we're taking away from our family time. We're happy to do it, but come Monday morning, if you're going to get a $30 different in payment, was it really worth it for us to educate you when we know they're not going to have a good experience? So just make sure that they truly understand what it is they want. If it's the hand holding, if they want the Nordstrom experience, figure it out, because they know where to go.
We are concierge. We are concierge lenders. We handhold the entire way.
Yeah.
And look, we are competitive. We are the number one lender in
Right.
Washington State. We wouldn't be number one if we weren't competitive.
Right.
The difference is with us is we're going to handle and help you on an individual level versus when you walk into that bank, it's like an assembly line.
Right.
It's like imagine having a car built. It goes on an assembly line and it meets a different person for every little part. Well, that can work on a car. It doesn't work on a person. What could possibly go wrong there?
Right.
Right? And that's the thing is people don't realize that until they get into that situation.
Right.
Is that whole,
Every playbook is different.
Yes. Yes.
There's no two clients that are ever going to be the same. And
Yeah.
we don't want to treat them like the married couple, the one child, the white picket fence, and a pet. That is so not what it was. That's 30, 40 years ago,
Sure.
yes. But now
Yeah.
today, no, everybody is different and we want to treat them as themselves.
As individuals.
Right.
Yeah, absolutely. Yeah. Well, it has been amazing talking with both of you. I think that we've covered so many incredible topics that viewers are going to find very interesting and helpful to them on their own journeys, financial and homeownership journeys. So thank you to both of you guys for
Thanks.
making the time today.
Thanks for having us. It was a pleasure.
And to all my viewers, please always reach out with questions and don't forget to like, follow, and subscribe. Until next time.